a person who's a non-resident in India can maximum remit up to $1 million per financial year per person from the NRO account to the NRE account. Per capita GDP of India is around $2,500. Typically, there are two outright winners when it comes to debt participation within this scope, discounting for the FCNR deposits, which we've already discussed about. And these are fixed deposits and mutual funds. So typically there are three investment channels which facilitate NRIs investing into India.
Why do you think, in your view, why do you think a NRI should invest in India? Welcome to Money Skills by Scripbox, a podcast dedicated to helping you manage your money better. I'm Varun Girilal from Scripbox, and today we have a special guest. It's not very common to find tax advisors with knowledge of both India as well as overseas. We have a special guest today, Nirav, a seasoned and experienced tax and financial advisor with knowledge of both Indian as well as overseas. I'm looking forward to Nirav simplifying the seemingly complex subject for our NRI investors.
Thank you for your kind introduction, Varun.
So Nirav, there have been quite a few changes in the union budgets around who is an NRI. So let's start with understanding who classifies as an NRI.
So according to Section 6 of the Income Tax Act, which defines the residential status, there are typically three forms of residence. So one is a resident, which is further divided into resident and ordinary resident, as well as resident and not ordinary resident. Then there are the non-residents, and there is a concept of deemed residents. For today's purpose, we'll like to focus completely upon the NRIs. So according to Section 6, the basics condition, what it suggests that there are two conditions. The first condition is that the NRI is a person who does not stay in India for more than 182 days in the current year, and there is a secondary condition as well. So if any person who is staying in India for more than 60 days in the current year or more than 365 days in 4 years preceding the current year, if any person satisfies either one of these two conditions, then he becomes a non-resident.
So, there used to be so much clamor around getting overseas jobs in India. And of course, we also have a little bit of ghar wapsi happening now.
Yes.
But there used to always be talks about a lot of benefits being available for non-resident Indians. So is it kind of best of both worlds? Are there some real good benefits in being a non-resident Indian?
So traditionally, there are no per se benefits for a person to become a non-resident. The key takeaway lies in the part that non-resident Indians do not have to disclose their foreign income in India. So they are only liable to tax on their Indian sourced income. And typically, this is very lucrative for people who are residing out of tax regimes which has a lower rate of taxes as compared to India. So for them, maintaining the NRI status becomes very important.
So can you give us a kind of cheat sheet in understanding these residency requirements?
Sure, Varun. So rather than going over a conventional dry flow chart, let me try to paint a picture. Imagine that you are standing at the crossroads to determining your residency status in India, right? There are two main roads that you will encounter. The road number one would be, are you an Indian citizen or a person of Indian origin? So if the answer to that is affirmative, then there are two lanes which can bifurcate thereof. The first lane would be that if your income, and typically over here, if your India sourced income is less than 15 lakh rupees, then in the current year, you have to spend less than 182 days. And in the 4 years preceding the current year, you have to spend less than 365 days. However, if your India sourced income is more than 15 lakh rupees, then in the current year, you have to spend a little lesser, which is you have to spend 120 days. And in the immediately preceding 4 years, you have to spend less than 365 days. So this was the synopsis of people who are either citizens of India or PIO holders. For any other category, the rules are quite stringent, which means that in the current year, you cannot spend more than 60 days. And in the preceding 4 financial years, you should not have spent more than 365 days. There's also a concept of resident but not ordinary resident as well, right? So what technically that happens is there is a cool-off period or a transitory period, right? For any non-resident, they do not directly become residents in India. right? So there may be typically a period of between 1 to 2 financial years, depending upon the history of the number of days spent by the assessee in India, where under the tax benefits of a R-NOR, resident but not ordinarily residents, are very similar to that of its NRI, which means that typically their global income or non-India sourced income is not liable to taxes in India.
So, Nirav, one thing that I have observed amongst my friends and family members who are outside of India, non-residents, they have been asking me about investing options in India. I think there's a kind of a buzz. Why do you think, in your view, why do you think a NRI should invest in India?
So there is definitely a buzz, and I think so that buzz has translated to a noise, and that is about the Indian growth story. Personally, for me, the key takeaways are that the rupee has been very buoyant, right? Uh, Although we have some degree of biasness over here, where we traditionally compare the rupee against the US dollars, and in the previous 3 years, you would have seen dollar appreciating significantly as compared to the Indian rupee. But however, when we broaden our perspective and we also look into other currencies, particularly if we look at to all the major G7 country currencies over the past 3 years, and during this 3 years, we see that rupee has been buoyant, which means that it has been flat against the G7 currencies, right? So there is definitely a play of a stronger rupee coming into play. There are all talks about dollar devaluation, the concept of Bretton Woods 3 coming into play, but not getting into those and only restricting our discussion from the perspective of the Indian rupee. I do think so. Right now, the per capita GDP of India is around $2,500, right? Traditionally, what we've seen is this number of between $2,500 to $4,000 is a point of inflection. What it basically means that the precipice of growth and the potential of the economy taking just a very steep takeoff right from these levels is high. We've seen this play unfolding in cases of major developing countries in the past, and we do feel that it is there. Relatively not much talked about part is the political stability as well as the continuity. While having no biasness towards any particular ruling regime, it is definitely in the interest of the nations to have one policy, one direction, etc. And lastly, I do feel the earnings growth of the Indian companies, etc., that is at pace, has historically been at pace, and the growth prospects have been good. So if we look at India as a hotspot, it is one of the most brightest hotspot when it comes to emerging markets.
Quite a few points. So, Amrit Kal, fastest growing large economy in the world. So, what do you think are the various investment options that NRIs can consider?
So, what are the investment channels that facilitate an NRI to invest into India, right? So, typically, there are three investment channels which facilitate NRIs investing into India. One is the NRO account. This is an account which is treated at par with the savings banks account in India, which means that the money which is in the NRO account is not freely repatriable. It comes with certain restrictions, both in terms of the amount. So, for example, the NRO can remit only up to $1 million per year per person through this account. And there are certain documentary requirements of soliciting 15 CA, CB for transferring the money either from an NRO account to directly to an overseas account or to an NRE account. The second account is the NRE account. As the name suggests, it's a non-resident external account. The proceeds over here are freely repatriable, right? And any income which is generated from the NRE account is usually not taxed to India. There is a common misconception over here where it suggests that any income through the NRE account is not taxable in India, which is not true. So, what I typically want to cover over here is, let's say if I'm investing into equities through an NRE account, right? Would the capital gains from the NRE account be which are received in the NRE account, will that not be liable to tax in India? No, that is not correct. Those will still be liable to tax in India. What won't be liable to tax in India would be the interest which is earned either in the NRE account, the savings account, or the NRE deposits. And the third and little talked about instrument would be the FCNR. So an FCNR account is basically a foreign currency non-resident account. It is an account in which you can hold the currency which is denominated in your host country or the resident country. So typically there are 8 to 9 currencies under which you can open the account. So the account can be denominated in dollars and other major currencies in the world.
So what I understood, Nirav, is NRE is when you invest in India from your earnings outside of India. If you do a fixed deposit through your NRE account, you don't pay tax. But if you do make an investment into mutual funds, taxes are applicable.
Yeah.
NRO is when you invest money that you have earned in India. It could be rental income, it could be from some of your past assets and income in India. So that is taxed both for the FD as well as for, let's say, mutual funds or shares. Yeah, it'll be now interesting to just understand these various options available, the steady return as well as the higher growth but kind of more volatile options. So, what are the various options available for an NRI?
So, in my opinion, the investable universe which is applicable for a non resident Indian is very much similar to that of a resident individuals, with the sole exception of some of the government sponsored scheme as well as investments through the post office which are not available for a NRI, right? So, within the ambit of, let's say, equity investments of direct nature, so direct equity, if any direct equity participation is done under an NRE account, a PIS needs to be associated with the NRE
So,
account.
what do you understand by this PIS, and can you have multiple PIS accounts?
Traditionally, there is one PIS account which is locked into a particular account. There is no restrictions when it comes to an investing into direct equities through the NRO account. You do not require a PIS, so it's particularly a free float. You can carry on the transactions without having a PIS associated to it. So that was the aspect of direct equities. Within mutual funds, I feel that the entire universe of investable options which are available to a resident investor is also available to a non-resident investor as well. Over here, I would just like to mention fleeting thought. There are some restrictions which are applicable for certain regimes like the US and Canada. So out of the entire investable universe of, let's say, 44 AMCs or 44 mutual fund houses which are there in India, only 8 mutual fund houses accept investments from US or Canada based persons, and out of these 8 AMCs, only 2 accept monies in online mode. Moving on to the next asset class within the ambit of deposits, I think so. The NRE, NRO, and the FCNR deposits give you a decent track record of participating at options at par with the resident investors. With regards to gold, the NRIs can take a participation in gold either through physical form, gold ETS, or even e-gold. What NRIs cannot do is buy sovereign gold bond funds, but if they have sovereign gold bond funds from the point of time that they were resident Indian investors, that is perfectly fine, that they can continue holding that. And just not to dwell much deeper into it, and the provisions which are applicable for real estate investments are typically available for non-residents if they want to buy a residential or commercial property. What is not accepted under the real estate domain would be agricultural lands, farmlands, etc., or plantation.
So, among these countries you mentioned, is there a lot? Are there more nuances when it's a non-resident Indian in US or Canada?
Definitely, Varun. So when it comes to investment from US per se, the US tax laws are designed in a certain manner which discourage US person who are either US residents or US citizens to participate into fund of funds in foreign regime, right? So typically Indian mutual funds are classified in a manner. Apart from the logistical compliance, there are certain denudative manners when it comes to the taxes as well, right? So typically mutual fund income is treated as a PFIC income. So PFIC income treats the income as ordinary income, and the worst part of it is that it is taxed on unrealized basis at the end of every calendar year, right? However, there are sophisticated nuances to consider. There are no eventualities whereby one can mitigate through the options of PFIC, but how to design and further strategize on those concepts to further make these investments for the US citizens is something that we can definitely look into.
I want to go back to a point you made about NRO and NRE accounts.
Yes, Varun.
Is it easy to move money in and out from your NRO NRE account in India to your overseas bank account, and are there limits for it?
When it comes to repatriation of money from an NRE account, it's a free float, which means that moving the money from an NRE account to your foreign account is freely repatriable. There are no restrictions, there are no permissions, there are no formalities which one needs to do. But however, when it comes to the monies which are lying to the credit of the NRO account, a person who's a non-resident in India can maximum remit up to $1 million per financial year per person from the NRO account to the NRE account or directly to the source country account. And for this purposes, Form 15 CA-CB also may be required, which Form 15 CB is basically an attestation by the chartered accountant, and Form 15 CA Part D would be the self-declaration.
Nirav, what are the various options available for an NRI? And in this regard, it will be good to understand the steady, safer kind of options, as well as those options which may be volatile but give you higher growth. So, what are the various options?
So, Varun, within the ambit of steady and low risk kind of instruments, I think so the differentiator could not have been more obvious to the optical eye as it is in case of debt as an asset class as compared to any others, right? So, typically there are two outright winners when it comes to debt participation within the scope, discounting for the FCNR deposits, which we've already discussed about. And these are fixed deposits and mutual funds. So traditionally, if we look into that part, I feel that fixed deposit as a product is something which is knitted in our culture, right? And there are those safe and steady returns. People associate a deposit to virtually being riskless, although there are underlying provisions by the RBI where a fixed deposit is only secured up to an amount of 5 lakh rupees only, right? But people kind of discount that, right? For people, the predictability of the cash flows, the dependability upon the tenure of the investment is something which has conversely been one of the major selling points and USPs of fixed deposits. Even after the recent tax law changes, etc., I would not discount of the debt mutual fund proposition, especially for a non-resident. And the reason that I say is, no, let's just take a ceteris paribus order where of FD as well as a debt mutual fund, both are yielding, let's say, 6% returns on an annual basis. We start off with, let's say, an investable amount of 1 crore rupees, right? So the value of the fixed deposit at the end of the year as compared to the value of the, let's say, the terminal value of the debt mutual funds, the debt mutual funds will have 1% extra absolute returns as compared to the fixed deposit. Now, the devil lies in the details. Why is this occurring in the first place? So, fixed deposits generate the category of income which is called as interest income, right? Interest income in India is taxed on accrual basis, which means whether or not the duration of the fixed deposit has matured or not, on an ongoing basis on every financial year, the assessee has to report that as an income and has to discharge the tax. So on account of the tax leakages over the investment horizon, which is in our case of example 5 years, it comes across that debt mutual funds on an absolute basis give 1% return, which is higher than fixed deposit. Now, if I were to slightly tinker around with the definition of debt on a pure play concept, and what if I bring into play hybrid structures of mutual funds to replace the debt mutual fund category, right? So, hybrid mutual funds in India are classified for the purpose of taxes as equity, but the core of it is still debt, right? And the tax rate which are applicable thereunder is 10%. So, if let's say instead of debt mutual fund, a participation is made considering the asset allocation, the strategic broader asset allocation of the client into a hybrid fund, which is taxed at 10%, the terminal value of such hybrid funds at the end of 5 years would be a whooping 7.6% higher than the terminal value as compared to fixed deposit.
Wow, this concept of a hybrid fund, where you say there are certain hybrid funds which give you steady returns, I think it's something NRIs should proactively consider in bringing into their portfolios. You kind of get a best of both worlds: steady returns, lower taxation. Steadier
Definitely.
returns and lower taxation. Nirav, you threw light on the taxation for steadier options. What's the tax structure applicable for growth kind of options, like if you're investing in an equity mutual fund or directly in equity shares?
So, within the ambit of, let's say, equity as an asset class, the investors has options right from direct equity, equity mutual funds, PMS, AIFs, and structured products. So, all of these as an offering are available to the non-resident investor. Now, one part that I would like to just take you through is that the equity AUM of the mutual fund industry stood at 1.91 lakh crore. This was back in 31st of March 2014, 10 years back. Fast forward 10 years forward, 31st of March 2024, that number stands at a whooping 23.53 lakh crore. And also to give you a background, back in 2014, the HNI as well as the retail investors, they had 87% of the AUM share. And fast forwarding into 2024, they have a whooping 92% participation into the equity AUM, right? So clearly we see over here that for not only for retail investors but also for high net worth individuals as well, equity mutual funds has been something which is the preferred choice of investors.
Nirav, you mentioned about TRC or tax residency certificate earlier. So,
Yes.
what is a TRC? Are there certain countries where if you're tax resident, you have beneficial or lower taxes?
Right. So, TRC is a fundamental prerequisite when it comes to any person who wants to claim the benefit of the double tax avoidance agreements. By this, what I mean to say is if there is a provision in the DTAA with the source country as well as India, where under it can be anything, it can be a tie breaking scenario of residential status, it can be with regards to concessional withholdings on their tax dues, or it can be for concessional rates of tax. It is a prerequisite for the NRI to solicit a TRC if he wants to claim any beneficial provisions as listed out in the DTAA over and above the corresponding tax statute. There are no per se defined format of a TRC, but what the TRC basically attests is that particular assessee is a tax resident of a regime, what is his tax identification number, and usually in case of presence based systems or territorial based systems on the basis of residency, affirming that resident to that person to be a resident of the particular country. Also, there is no set procedure to solicit the TRC.
So, Nirav, are there countries where if you're tax resident, you could be paying lower taxes?
Yes, Varun. So, just to give you a couple of notable mentions of some amount of synergies which are arising out of it. Let us imagine a person who is resident in Singapore and he wishes to invest into the Indian mutual fund and participate in the India growth story, right? So, typically between the DTAA tax avoidance agreements which are there in play between India as well as Singapore, there are two basic articles, the Article 13.4 as well as Article 13.5. So, Article 13.4 suggests that any shares or immovable properties will be liable to tax in India. Article 13.5 suggests that any capital gains on any asset apart from the assets covered in Article 13.4, so apart from direct shares as well as immovable property, the gains will be offered to tax in Singapore and not in India. Right? So let us imagine a hypothetical scenario where a person invests in India, he solicits the TRC from the Singapore IRAS, right? And corresponding to that, he also has to file a Form 10F with the Indian tax authorities, right? So, in that particular year, if that Singapore person has realized any capital gains out of mutual funds in India, right? What the DTAA suggests that capital gains would not be liable to tax in India, but it will be liable to tax in Singapore, right? Singapore as a regime does not have the concept of capital gains tax, which means that if these capital gains tax are not taxed in India, these will not be offered to tax in Singapore as well. But having said that, there are a few prerequisite conditions also, which means that there is one more article, which is Article 24, subclause 1, which mentions that any person who wants to claim this particular methodology of beneficial provision of taxes under the DTAA will have to remit the proceeds back to the source country, which means that immediately after the realization of gains, the gains as well as the proceeds needs to be repatriated back to Singapore. They can be definitely bought back to India and further can be reinvested, but the potential of remittance is definitely there. And similar provisions can also be extracted towards the Gulf countries. So whether that is UAE, Qatar, all of these regimes.
Okay, I have a question around taxation for a favorite investment of Indians. That's real estate. So, like Indians in India, when Indians go overseas, they still love real estate. So, are there some key things they need to keep in mind with regard to the real estate in India, whether they are selling or buying a property or renting a property?
Sure. So, I'll address it in two parts. One is the concept of renting and the other is the concept of selling, right? So, as per the section 195 of the Income Tax Act, any payment of any income made to a non-resident which is on account of any income, in this case rental, the person who is making the payment of the rent to the non-resident is liable for tax deduction, right? Typically what happens is the tax is withheld in advance at a rate of 30% plus surcharge plus cess, right? And when we look at the renting proposition under, let's say, section 24B of the Income Tax Act, there is a standard deduction of 30%. So whenever there is, let's say, a concept of renting out, the NRIs get into a situation where under which they have to claim that as refund from the tax authorities. Now, secondly, with regards to the proposition of soliciting or selling properties in India, so the consideration from the sale of any real estate property in India has to be transferred mandatorily to an NRO account. It cannot be transferred directly to an NRE account. That is something from an investment channel perspective. And the second part is that the rate of tax deduction applicable in case of sale of long-term real estate in India will continue to be at 20% capital gains tax rate plus surcharge plus cess, right? Typically in India you get a provision and this tax deduction is done at the sale value and not at the gains value, right? But however the taxes which will be applicable will be on gains. So even with regards to selling a property, more likely than not, NRI ends up in a situation where under which he has to claim refund from the tax authority.
That brings us to the end of this session. Thank you to Nirav for simplifying the seemingly complex and heavy subject of taxation for NRIs. I'm sure some of you may have some questions. Please leave it in the comment section. We'll be happy to address them. If you did like this session, please like, share, and subscribe.